When we look around the country, Brisbane's median house price is at $817 compared to our $625. Sydney's median house price is already at $1.1 million compared to our $625, and Melbourne at $778,000. If you are considering purchasing any property type, whether it be a house or a unit, you need to look at how it's historically performed.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Today, I'm going into the question that I'm getting asked a lot at the moment. What do I buy with a $550,000 budget? And to really answer that, I wanted to do a deep dive comparison on how houses have compared to units, both over the last 10 years and historically over the last 30 years, to see what is the growth rates, what is the rental yields, what are the trade-offs potentially in buying a unit over a house, and could it still make a good investment for someone that does have a $550,000 budget? So if you're in the market like we are, buying properties every week with our buyers agency, selling properties every week with our property sales, you would know that you can't now buy a reasonable house anywhere in Perth for under $600,000. And that makes sense, right? Because the median house price is $625,000 now. And when I look backwards to 10 years ago, median house price in Perth was $530,000. So not that different to what it is today still, around $95,000 less than where it is today. And so over the last 10 years, that represents an average annual growth rate from the 530,000 to the 625 that it is today of 1.6% on average per year. Sounds pretty low, doesn't it? Because it has been. And so I was asking myself, well, how has the median house price changed over 30 years? And so I looked back at the median house price in 1994, which was approximately $120,000. So that represents an average annual growth rate over the 30 years of 5.65% each year. And that's in line with what I expected things to be. So over the past 30 years, when I also look at the individual suburbs and the changes in their median house price, and I did have an exclusive study commissioned by REWA because I couldn't find anything longer than 20 years available. And I wanted to capture as many growth cycles as possible when looking back, because even missing one growth cycle, it really, only shows you a limited picture if you're only capturing two. So I wanted to capture at least the 30 years, which was typically 3 growth cycles. And what I found when I look at the individual suburbs, and this is how we go about informing our suburb selection when we're choosing our suburbs for our buyers agency clients, is that typically suburbs varied in their 30-year growth rates between 4 and 7%. Now, there was a few that was less than that, a few that was more than that 7%, but when we look at most being in that 4 to 7%, and it varied by price point and obviously desirability of the suburb, underlying factors that have driven the growth to be higher or lower, made sense to me when I compared that typical range of 4 to 7% with what the median house price has done over the same period, 5.65%. That sort of sits in the middle of that 4 to 7% quite nicely. And it makes sense to me that the median has done that, with half the suburbs doing better than that and around half the suburbs doing worse than that. So I think that 5.65% median house price change over 30 years is a good benchmark and what we should expect over the longer term for a median priced property. So even though most Perth suburbs have experienced 30 to 50% growth over the last 3 years, some commentators are saying that we're getting overpriced, and others are saying that we might be reaching the top of our growth period. I think the majority aren't saying that. I'm certainly not saying that. They're just looking at the 30 to 50% growth over the last 3 years and saying, gee, that's a lot. How much more can Perth really grow? But what I'm very much focused on is our average annual growth rate, which was 1.6% over the last 10 years. It's still got lots of growth to make up for and be in line with that 30-year average, which I just said was 5.65%. So that's why I believe there could be at least another 40 to 60% growth to get back to this long-term average and be more in line with the other capital cities. If we experience that 40 to 60% growth on our current median house price of 625, that would set us up to be at around $900 to $1 million median house price. Sounds high, doesn't it? And it's a little bit hard for us to contemplate, could we actually be worth $1 million for the average house, the typical house in Perth, within 2 or 3 years? And it does seem hard to imagine. But when we look around the country, Brisbane's median house price is at $817 compared to our $625. Sydney's median house price is already at $1.1 million compared to our $625. And Melbourne at $778,000. And so Perth seems to me to be really undervalued along with Melbourne. It makes it seem a lot more possible that we could be worth 900 to $1 million, especially when I consider that Brisbane, Sydney and Melbourne are all entering their growth phases again. And the more that they grow and make us look undervalued, yes, we're growing at a faster rate. I think we're going to catch up. And I think we're going to end up at somewhere between $900 and $1 million before we get to the end of this growth phase. I'm putting it out there and I'm happy to be wrong, and I'm not counting on it being right. So happy to state that. Now, when it comes to many people at the moment, even when we look at 625, that's becoming hard to afford. First home buyers, how do they scrape together enough to get into their first house? And it certainly helps if they have a partner to pull funds together and get into their first house. And many investors that are trying to make their first purchase, or they've got a few properties already, with interest rates having gone up, their borrowing capacity is more limited. Many people have this budget at the moment of $550,000, which, as I've said, is below the median house price of $625, and you're not going to really get a good house anywhere in Perth for that anymore. So I really wanted to explore now what opportunities exist to buy a unit, and how have units compared to that historical growth rates over the last 10 years and 30 years that I just discussed for sales, for house sales and the housing market, houses. So before I jump into that, what is actually classified as a unit? And I want you to understand why the stats can be a bit blurry for units. So units have everything lumped together that's pretty much not a house and not land. So units include high-density apartments, think CBD and that sort of style apartments. They include the older unit complexes, think West Leederville, Mount Lawley, Inglewood, Chewett Hill, all these older style unit complexes where they have a much higher land component, not as great a density as the city, West Perth, East Perth apartments, but they're a lot older, so they do have their negatives that come with that as well. What else is included in the unit basket? Well, we've got townhouses, and it's really anything that has a strata title that doesn't have a green title. So townhouses are in that basket, and in other capital cities, they've become a lot more sought after because people can't afford the houses. So, watch this space on those. And they also even include a duplex half, which technically has a strata title. And so a duplex half does have a fair bit more land, typically in the sort of middle ring suburbs that they were originally created as a more affordable option before they started creating other more higher density forms. And back in the day, that would have been a higher density, a more affordable option to get into. So with all of these being lumped in the same basket, the stats are very blurry for unit data. And I still wanted to explore what are some of the conclusions that can be made about units based on the historical data and compare that to houses. So it still is valuable even though they're all lumped together. Now, When we look at 10 years ago, the median unit price was $440,000. That's just a $90,000 difference to the median house price at the time, which I said was $530,000. So pretty close gap between houses and units 10 years ago, $440,000 versus $530,000. Now, with the median house price today being $425,000, it's actually cheaper, or at least the median unit price says it's cheaper than it was 10 years ago to buy a unit in Perth, which is remarkable, isn't it? $425,000 today, $440,000 10 years ago. So with this, marginally negative growth rate, what we've seen happen as houses has grown is that the gap between houses and units has extended out to now being at $200,000, making units seem really undervalued. So 10 years ago, the gap was $90,000 between them. Now it's $200,000, with houses growing a lot quicker than units. And when I look back 30 years ago to 1994, the median unit price, according to CoreLogic, was the same as houses. There was no gap statistically at the time between the two. So approximately 120,000. So over that time, when I look at the price in 1994, 120,000, the price today at 425,000, units have grown by 4.9% average annual growth rate over the last 30 years. And it does seem a lot higher than I would have expected units to have grown at. Regardless, it's a very reasonable rate considering the last 10 years has been negative and stagnant. So a lot of that change in the median house price must have happened in the preceding 20 years of this overall 30-year period that we're looking at. So what have I seen when I look at individual growth rates of specific property types? And I analyze many properties all the time, and I'm constantly looking at how has each property type performed historically. And what I typically see is that units perform anywhere from 2 to 5% average annual growth rate over longer periods of time. So that makes a lot more sense to me when I compare the typical growth rates I see for houses is anywhere from 4 to 7%. So 2 to 5% for units makes more sense to me. Now, the higher land component that I see in units, and the better the location and desirability in general, so similar attributes to what makes a house sought after, is that I see a better growth rate typically on villas and duplexes, followed by then followed then by the older unit complexes, and then higher density apartments being the worst. So the higher density apartments I typically see around that 2 to 3%. I typically see villas and duplex halves around that 4 to 5% end of that spectrum. There's always exceptions to the rule, and that's why you need to look at case by case if you are considering purchasing any property type, whether it be a house or a unit. You need to look at how it's historically performed. And ultimately, we know what drives growth on anything is it all comes back to supply versus demand. So when we've got limited land in an area, when we've got codings and zonings not necessarily supportive of greater density going in, when we've got limited supply getting created, then that puts pressure and the demand exceeds supply and pushes up prices. So no different to houses there. So with all of this in mind, the growth rates have been less from what I've seen anecdotally on the specific properties for units at typically 2 to 5% versus houses at 4 to 7%. Why should you consider a unit if your budget is $550,000 or below? And I've come up with 4 reasons to cut through and for you to see whether this might be an option for you. Now, from the above stats, it's clear to me that units are way undervalued, and there should be a significant correction and closing of the gap, taking growth back to being in line with the long-term averages, because we've had negligible and negative growth in units at the median house price level And when I look down at the specific units at the moment, certain segments of the market are coming back earlier than the others, but still there's a huge amount of catch-up that's needed to bring us back in line. And if houses are going to go to 900 to a million, even if the gap stays the same as it is now at 200,000, then we could likely see units being at 700 to 800,000. And when we compare that with the prices today at 425, a lot of growth upside there that should happen at some point. I don't know exactly when, but I'm seeing it already starting to occur. So there's a lot of upside in the shorter term is my point there. So even if it might not suit you for a long-term hold, you could certainly benefit and gain a lot of wealth in the shorter term. My second point for why you should consider purchasing at 550 or below, and it leads in nicely from the first point, is that you can still build wealth with a 4 to 5% average growth rate over the long term. And even at 4% growth, buying a $500,000 villa or something today would potentially be worth $740,000 in 10 years' time. And that's based on a 4% growth rate, which is very conservative and certainly possible. So going from 500,000 today to 740 in 10 years' time. And I think that things will probably exceed that. Certainly if the median house price gets to that 900 to a mil, I think this median for units could be a much, much higher. And I'm looking at the change in a $500,000 unit here. So in 20 years, when we extrapolate that further forward, a 4% growth rate would change a $500,000 unit to a $1.1 million unit in 20 years. So just over double in 20 years. So if you only put $50,000 to $100,000 deposit in, that's still going to be a great return in 10 years. It would be a 16.9% average cash on cash return per year if you invested $50,000 or a 10% deposit into the property, which a lot of people that are buying at the lower end typically do have that 10% deposit only. But if you invested a 20% deposit, you're looking at a 9.1% return on that 100,000 invested. That's the cash on cash annual return average over 10 years. So, and that's not counting the rental return that would be on top of that. It's going to be pretty substantial when we look at what units are at the moment. So certainly beats the pants off shares, and the leverage, even though the growth rate on the whole properties is less than what it might be for a house at 4%, the leverage still gives you a very decent overall return, especially when we count the rent on the top of that. So the share market historically has performed at 10% overall, and you can see, when you're not usually using leverage and loans in the share market, that when you use a property loan and you put in either 10%, we're looking at a 16.9 compared to what you might get in the share market, and a 9.1% return for 100K invested. And that's just the capital growth return. And when I quoted the share market return at 10%, that's the total return for both dividend and capital growth. So if you go and add another 7% or so, or 6% onto this for the rent return, then you're going to be doing very well compared to other asset classes still. Now, point 3 of why I would look at buying a unit if I had a budget of 550 or below is that with a lot of the growth likely to come over the next 2 to 3 years, is going to give you an equity gain that you could use to leapfrog into better assets. And so just because you start out buying units or dump houses like I did and renovating them doesn't mean that you keep buying them forever. And I've seen this evolution with myself personally and with our clients, and everyone has to start out somewhere. So don't necessarily look at it as a forever type of property that you're going to keep buying. I'm not suggesting that you sell your units either, because as part of an overall portfolio, they can make up more of an income component. And every time you buy and sell properties, you have changeover costs. So you'd only sell it. I'm more a fan of selling those higher density, more modern apartments that are only going to get 2 to 3% growth And so those assets I would suggest selling strategically. But if you've got an older unit complex, I would look at it case by case as to how the historical growth's been on those. Really with any villas or duplex arbs, I'd look at how it's historically been on those too, but I'd be much more inclined to keep those as part of an overall portfolio longer term. So you can use it as a leapfrog to get into better assets, and you don't need to be buying units forever. And a lot of people just think in this black or white mode and worry about what other people are going to judge them on for what they buy or don't buy. You've got to start somewhere. And if you've only got a 550k budget, well, what else are you going to buy for that? When we're still one of the lowest median house price cities in Australia, you're going to have to go regional, which I think the risk would be much greater, and returns would potentially only be the same as what you're going to get on units if you can still make a good selection. So I still think it's a great option compared to buying somewhere else that's not in its cycle like we are for growth ahead, and buying somewhere else that might have the risk elements that we don't have when we're a larger capital city. Now, my fourth reason and final reason for why I would look at buying a unit if I had a budget of $550,000 or below is that while the average growth over the longer term we expect to be less and the houses to be higher, based on the current median house and unit prices, the yield for houses at the moment is 5.4%, still very attractive. While the rental yield for units is 7.3%, which is nearly a full 2% higher, and just goes to show to me how undervalued units are, because the 7.3% is unheard of, and people go to commercial properties at the moment for a 6% yield. So when I look back 10 years ago, the yields were much closer together, with houses being at 4.5% and units being at 5%. So only a 0.5% difference. We're now out to a full nearly 2% difference, 1.9% difference in between the yields. So providing that your strata fees are not too high, even and with interest rates at 6.5%, typically a unit's going to be a lot easier to hold when its gross rental return, if its gross rental return's above 7%. That's the other major reason that can be worth looking at buying a unit. And what I've seen over the longer term is people that hold their properties ultimately still do well. You don't want to be selling out when things get difficult, and having the higher rent helps you hold it through good times and bad. So to recap today, we've looked into how houses have historically performed and why I think there's still likely 40 to 60% growth in the median type of property over the next 2 to 3 years, taking us to around $900,000 to $1 million. I've looked at how out of whack and undervalued units are, and that the growth has been almost negligible over the last 10 years. And when we looked back over 30 years, the stats showed us that we had a 4.9% growth rate. And so, but I've typically seen anywhere from the 2-5% range of growth, and that there's either way, there's going to be a lot more catch up, a lot more closing of the gap to be seen, and a lot of potential for short-term growth. And we finished on what are the 4 major reasons to look at a unit if your budget's only $550. Well, what's the alternative? You're going to sit out on the sideline and do nothing? We've seen that there's going to be that short-term catch-up, which is going to surge you much more than the long-term average growth rate. We've seen that, you can still build wealth on a 4% average annual growth rate, and you can then, most importantly, use that equity to step into better assets and leapfrog into better assets. It doesn't have to be forever. And finally, the higher rents do certainly help with holding the property. And if you are transitioning towards retirement or wanting to replace your income sooner, then it certainly warrants taking a look. I mean, if people are running out and buying commercial properties, and they're incredibly popular or at the moment all around Australia, and they're getting a 6% yield, I'd prefer the less riskier option of a unit and get a 7% yield without all the risk that comes with commercial. And of course, there's other reasons to buy commercial, having a larger asset and not as many properties to worry about and have details about, then commercial does still get growth as well. But if your budget's limited and you want cash flow, I'd be looking at units. Hope all that makes sense, and hopefully it's really given you some insights. I enjoyed the research of putting this all together. And if you've enjoyed this episode, please go and give us a review or a rating on Spotify and iTunes and share it with your friends. Thanks for tuning in. Catch you on the next one. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.